Hi, everyone, and welcome back to the Ask Avidian podcast. This is Jake Borbidge, Chief Investment Officer with Avidian Wealth Solutions. Let's get started.
Yeah, the green across your screen, a welcome relief for a lot of investors.
Markets have opened steady in Asia despite the stalled peace talks between the U.S. and Iran, but the price of oil is up.
Anthropic has decided not to release its latest AI model to the full public.
All right. Questions?
So just to kind of recap, so we're in about a third of the way into the year, so a little bit more than the quarter end, and wanted to touch base on performance. Been a bit of a choppy but generally upward trending market. If you looked at where things are at today, most indexes are trading at all-time highs. You would kind of think, okay, if I just woke up this morning and I looked at where things are trading and where stock prices are, you could almost forget the fact that we've been in multiple different geopolitical conflicts this year. You could forget the fact that tariffs are still something that is top of mind for a lot of people that are looking at data. You'd forget the fact that our unemployment rate is, kind of starting to creep up. And you'd also forget the fact that there are a rising level of delinquencies in credit card payments across the country, right? The health of the stock market, the health of the U.S. economy, and the global economy has been extremely resilient this year. And also the risk appetite for investors has been fairly robust, where they've been able to shake off a lot of the, otherwise kind of negative news developments. So one that we'll just touch base on real quickly is the Iran war. So I'm sure everyone listening to this knows that there was a ceasefire, 2-week ceasefire, that recently expired or was set to expire, but was extended. And I think it's indefinitely. It's a little unclear as to what the terms of this ceasefire are, because during this ceasefire, things seem to still be exploding. So something is being fired, and that hasn't fully ceased. We've seen ships, taken by both sides of the ceasefire. However, I think what the markets are taking away from this ceasefire is really just kind of shrinking the tails of what could potentially go poorly with this conflict, with the war in Iran. And so the fact that both parties are at the negotiating table, they've been there multiple times, is really telling the market that you can start to ignore the extreme tails of a extremely long and drawn out conflict. You can ignore the extreme tail of a heavy number of U.S. boots on the ground in Iran. I think the market is starting to discount those things as very remote possibilities, where a couple weeks ago or maybe a couple of months ago it was starting to assign a meaningful probability. And so that's really, in my view, why you have seen the markets rebound and start to pay attention to things that matter longer term, which is earnings, which is level of debt of companies, things that drive the fundamentals of equity ownership. And really, as equity owners, we own the earnings of the company, so that's what our focus should be. However, one of the, I'll call it, lasting fingerprints of this conflict is definitely oil prices. Oil prices get a lot of attention in the news. Most of the time, the news, and just kind of come back. One of the themes of our podcast, we like to separate the news from the noise, right? So the news pays attention to oil prices. We also do as investors, but we look at different things. So the news is going to write a lot about where spot prices are trading. And the spot price is really just kind of, an indicator of where you would have to transact today if you wanted to buy or sell barrels as a financial trader. Not a ton of oil transacts at the spot price in the physical terms, right? So that's more of a financial instrument. So individuals that are actually going to utilize oil for, something that their companies need to produce, they tend to look, I would say, a little bit more at the futures market, try to understand where oil prices are going over, kind of the medium term, call it 3 to 6 months out. And a lot of companies actually will hedge their oil price exposure if they are large consumers of oil or oil-related commodities. They may hedge some of that exposure, especially if it's a meaningful piece of their cost structure. So when we look at oil prices, we try to understand the impact of oil prices on earnings. It's really not the spot prices that you pay that much attention to. You start to look at the futures curve. So if we look at that curve today, and again, futures curve is going to be what is the market telling us oil is going to trade at in 3 months, in 6 months, in a year. We've noticed obviously some changes. So the front end of that futures curve is the spot price that has climbed up significantly since the start of the year, start of the Iran conflict. I want to say it topped out at 120 was maybe one of the highest points that it was trading at. That might be off by a few bucks. And it's come down a little bit. And every time we get news of a ceasefire or news of some kind of calming, you see oil prices on the spot market sell off substantially. And then if there's, if there's more conflict or less certainty around, less certainty around peace talks, you'll see those spot prices ramp back up, right? Quite volatile in the spot market. What matters more again is kind of where oil prices, where longer term expectations on those prices are going. And that's where markets will start to factor in, not just the temporary disruption of this conflict, but the longer term, disruption of lost inventories, lost production to overall global supply for oil. And then how does demand respond? Does demand stay static and prices increase, or does demand decline and prices stay the same, or somewhere in the middle? And I would say it's probably somewhere in the middle. But we have also seen those medium to longer term expectations steadily climb as this conflict has drug on, beyond weeks into, now we're in the months in terms of counting the time frame. And so we're seeing those prices start to climb up, call it $10 to $15 or more from where they started the year. And the increase in those prices is actually kind of stretching out more than just the summer, more than just kind of year end 2026. You're starting to see an increase in the futures curve going out, 2, 3, 4 years. And so I think what the markets are telling us is that, yes, this conflict may conclude, and maybe it concludes in a few weeks, maybe it concludes in a few months. It's not going to be something that lasts multiple years, but the impact to overall global supply is going to have more lasting effects that might span the period of years and not weeks or months. Why that matters to me personally, and I'll just kind of give you a very simple and straightforward example of how it starts to impact industrial companies and other manufacturing companies around the country and around the world. So in prior podcasts, we've talked about ranching and owning land and how that can be fun and kind of an enjoyable thing to do. Currently I am out of the market. I would say I am between ranches, which is a very first world Texas thing to say. So I'm doing my research on, what is the next property that I buy as both an investor and a consumer and somebody that enjoys being out in the country. And so obviously, the land matters, location matters, topography matters, what's on the property matters. But then also, kind of your vision, what do you want to do with that property matters as well. And so that's typically, where my head is at when I'm looking at land. I'll stand in a field and I'll try to envision, 6 months from now with, some investment. What could this field or what could this, patch of woods look like? And that's really where I try to kind of, think ahead to. A lot of times that involves excavation, involves usage of heavy equipment. Sometimes that involves timbering. But more often it involves, track hoes and bulldozers and all that kind of fun Tonka stuff that, I'd love to be out there driving around myself, but typically because of my day job, I have to hire somebody to do it. Those tools use a lot of fuel. And so when I look at getting the cost of a project bid, and I ask contractors, how much is this thing going to cost today? That price has climbed substantially because one of the big things in their cost structure is oil. Not oil, is diesel fuel. And it could be gasoline, but it's typically diesel fuel for that, really heavy equipment. These smaller contractors, they're probably not hedging. So they're just, they're buying diesel fuel for the project. They're bringing it to the project that they're a smaller contractor. If they're a bigger organization, they might hedge, a few months out. But the day rates on that equipment have climbed substantially. I'm not going to quote prices because I don't want to give any secret sauce away from any of the guys that I've been talking to. But we're seeing significant increases that track, closely to the level of increase that we've seen on oil. Now, obviously, diesel is not 100% of that cost structure. We've seen diesel climb from the $3 range to around $5, but it's a big chunk. And so the commensurate increases really for them just to stay, break even or slightly profitable, are still in the mid to kind of high double digit range. So as you look at those projects, the reason this matters is because, near term, maybe those prices are high, maybe those bids are a little bit elevated. Real estate investing, it's a longer term game. Should I think about, I might be able to buy this property. Maybe I just don't do the project for a while. Maybe I wait, wait, like I said, 3 months, 6 months. So I start looking out that futures curve and deciding, do I have the expectation of better bids in the summertime, in the fall? Don't want to wait multiple years. And in that case, you do see the hopes of potentially slightly greener pastures, but still higher expenses, higher costs than I would have experienced if I, bought in and started this project a year ago. And so again, just kind of one real world example of how this stuff can impact, the real economy, just for a very simple and transparent way to think through it. Obviously, if you're running a manufacturing company that is, using heavy equipment to build things or to assemble things or to cut things or to weld things, all those things require power. A lot of that power is generated through the use of burning hydrocarbon fuels. Okay, so let's talk about another. So obviously, one of the reasons that oil matters to consumers is because it drives a piece of your consumption bucket, even if oil is not part of kind of the core CPI that the Fed likes to focus in on. It is part of the wallet share of things that come out of your pocket to pay for just the normal day-to-day expenses of living. Another thing that has been getting a lot of attention is the price of electricity. The price of electricity is something that I would say has been climbing for some time now, for factors that have nothing to do with what is current in the market. So one of the reasons in Texas that we've seen electricity prices climb, not including the last 2 or 3 years, but leading up to that, is really just the build out of our grid's infrastructure, right? We want our grid to be more resilient to storms, more resilient to outages, and more just resilient generally to the increase in power demand from growth of residents, population increase in the Texas area. So that has been going on for a long period of time, probably 10 or more years, right? I'm striking a blank when I try to think about the last time that I paid single digit cents for a kilowatt hour of power. Or sorry, maybe it's a watt hour of power. So that price has been climbing steadily. However, recently, we'll call it the last 2 or so years, data centers have really kind of entered the mix in terms of the incremental demand on power. And so that's got a lot of people worried about the impact of data centers to just kind of their day-to-day life. So I wanted to debunk a couple things. And, I listen to some podcasts too. I mean, these are things that, some of these things are on podcasts, frequently. So many of you have heard about this, but I like to educate people that, might only listen to the Ask Avidian podcast because it is the best one around. So water consumption. I know there's a lot of, news stories around you don't want data centers in your backyard because they're going to suck up all your drinking water and you're not going to be able to, take a shower or water your lawn, especially if you're in an area that doesn't get a lot of rain. And I would say that's, that was maybe a relevant concern a few years ago when the first data centers were being built. And efficiency was really just not the focus. It was mainly just, hey, let's get these things up so we can see if they actually work and provide some value. Today, data centers, most of them operate on what's called a closed loop system, meaning that, once you fill that data center up with the water that it requires, right? So there's cooling pipes, there's other systems that require water. Once those are filled, they don't need to continually be refilled. A lot of that water is recycled, taken from a hot place, carries that heat away, goes to a cool place, lets the heat release, and then recycles, just like refrigerant in a refrigerator or refrigerant in a air conditioning system. You don't constantly refill the refrigerants in your other cooling systems, and water acts as a kind of large scale refrigerant in these systems. So the concerns around data centers using up all of the usable water, I think that's something that we've kind of largely moved past. The second is okay, are data centers going to consume all of our electricity? We were a little bit thin on spare capacity a couple years ago, and we noticed that when we got, at least in Houston, we had some long strings of very hot and very sunny days, and we started to see some grid failures or just really getting really close to stress on the grids, and that's something that has occurred multiple places in the U.S. Obviously, I live in Texas, so that's what I remember most concretely, and so that's been a concern for a number of years. But if you add in data centers, that makes you say, okay, well, now these data centers, which are known to consume large quantities of electricity all throughout the day, especially even during peak hours, are these data centers going to decrease the reliability of the grids? And so that's when you, so again, this is something that I think was a big concern a couple of years ago. A lot of data centers that are built now, especially the larger ones, are using what's called behind the grid power generation. And so why we bring that up is because the term behind the grid has largely been used to diffuse the concerns around increases in power generation. And that's what, when I listen to reputable podcasts, that's mostly what I hear. And I think there's some merit to that. And so we'll talk a little bit about that. So what does behind the grid generation mean? It really means that that if you're consuming power, and you can do this at your own home, right? And you can kind of be like off the grid or behind the grid at your own home. The way residents do that is they would have a bunch of solar panels and a battery system on their house, and that would be their primary source of power. When they need a little extra power, they may take some from the grid. A lot of times they're actually sending power back into the grid, right? That's a kind of easy way to think about what does behind the grid look like. Obviously, it's much more complex for a large data center that's using a ton of power. It probably involves more than just solar panels. Probably involves gas-fired power generation. Think about a gas turbine. Sometimes it uses diesel-fired power generation. So a diesel generator would be some of the equipment that you would see in these behind the grid systems. And those power generation systems, diesel energy, diesel. Sometimes it's wind, sometimes it's solar. It's usually a combination. Gas-fired turbines, another one. Those would serve to produce the amount of electricity that you need, kind of at that peak utilization of the data center. And then off peak, they actually have the ability to provide power back to the grid. And so the narrative, which I think there is some merit to, is that behind the grid power generation associated with data centers actually increases the reliability of your grid, because that excess power, when it's not being used, can be sent back into the grid. So I would say there's some potential of that being a positive. And it also increases the aggregate supply of power, which I think there is some truth to that as well. Where I am not seeing anybody paying much attention to it, it's kind of made the news here and there, but definitely not the podcast circuit yet, is the equipment used to create this power generation. And the reason I bring that up is because there's currently, and we know this because we look at this as an investment opportunity, but there is currently a shortage of equipment used to generate electricity. Hyperscaler firms, data center companies have bought up most of the power generation equipment that is going to be produced over the next handful of years. And so I think the lead time right now, if you want to buy a traditional gas-fired turbine, you're in line for about 5 to 7 years, right? That's quite a long time to have to plan or to be able to get delivery of a piece of equipment. And so what you have seen is that the price increase, or sorry, the inavailability, right? The lack of availability of these systems is now starting to result in some substantial price increases for the equipment needed to generate this power, right? Why does that matter to the end consumer, the residential consumer? It really kind of matters when you think about how utility companies look at capital deployment, capital expenditures, and then how do they plan to pay for those capital expenditures? And I'm going to grossly oversimplify the process here. Hopefully hopefully nobody listening will take offense to my gross oversimplification, especially if you're in the power generation or utility company world. But a gross oversimplification is that a utility company will look at its capital expenditure needs. They have somewhat of a monopolistic control over the market that they sell power into. So they kind of have a set of customers they know are going to be customers. They have, very little negotiating power especially in a regulated market. Deregulated market, a little different story, but not a lot of negotiating power on the price that you pay for that electricity as a consumer. And so these utility companies, they can look at their capital expenditure budgets. There is a kind of a safety factor, you would call it, in profitability they bake into these projects, and then they pass on the rest of the cost to the end consumer. That matters because these utility companies still need to continue to expand their power generation capacity, right? They have population growth. They have things that they need to deal with. So they can't just let their power gen capacity stagnate. They need to continue to grow that to some extent as well. the prices that they're going to pay for that equipment obviously have gone up, right? That gas-fired turbine, if you want to get one of them, you're going to have to pay market price. That market price is substantially higher than it was a couple of years ago. However, the cost of that, or so the increased price there, again, thinking about how they budget for these things, they're just going to tack on a little bit of margin to that CapEx project, 10% on top, and then they're going to pass that increase on to the consumer. So while the consumer may not be bidding for electricity against a data center, they are in some ways bidding for electricity power generation equipment against data centers. So those are not necessarily day one price increase impacts, but they are kind of longer term price increase impacts that you can expect to see continue to materialize over the next few years. We think it's important to understand this, not just to keep you guys informed, but to also understand why we think some of these private investments like data centers are attractive, but also why they might be an effective inflation hedge for inflation that you might not really be thinking about on a day-to-day basis. Okay, so enough on data centers. We're going to switch gears and in trying to weave this correctly, doing a little bit of touch and go. So SpaceX, a couple things we've talked about SpaceX in the past. SpaceX has, confidentially filed for an IPO. Rumors that the $1.75 trillion mark are might be a little bit low. I think the most recent rumors are that SpaceX may try to go public at $2 trillion. There's actually some rumors this week also that they are buying Cursor, which is a competitor to competitor to Anthropic. They have a competitor product to Claude Code, which is quite good. It's an area that SpaceX, which now includes XAI, which includes Grok, their own large language model, was somewhat lacking in, right? So that company, even though it's heading towards IPO, is trying to keep its own deal pipeline going. However, the thing that we wanted to touch base on with regards to the IPO today is really just the massive effect that IPO specifically, and then there are some other large private companies. OpenAI is one, Anthropic is one, and there's a number of other large private companies that will be going public, potentially could be somewhere in the range of $4 trillion of migration from illiquid wealth and illiquid ownership of companies to liquid ownership of companies. So what we just wanted to touch on real quickly today is, what does that look like from a market dynamic perspective? And really what it means is you've got, trillions of dollars of wealth that is currently locked up, untradeable for the most part, in a portion of somebody's portfolio that would be representing their private market asset bucket, right? So think about your private equity bucket in your portfolio. For most people, it's 10 to 15% of their portfolio. If you're heavy users of private markets, for a lot of people, it's significantly smaller than that, right? So those assets represent a chunk of that small piece of the puzzle. When they move into the public market space, now they are in a piece of the puzzle that is substantially larger, right? You've transferred $4 trillion of market wealth into the public market sphere. If you are a portfolio manager at a sovereign wealth fund, likely you either only cover privates or you only cover publics. If you are the portfolio manager on the private side, you've just seen a large chunk of your portfolio leave, which means there's a little bit of a vacuum. You've probably received cash in terms of liquidity, right? To oversimplify, and you've got to find new private equity deals, private equity companies and funds to invest in to fill that void, right? So it creates an influx of cash on the private side and a hole in the portfolio that needs to be filled with actual companies. On the public side, it's kind of the opposite, right? It's like pouring water into a cup that's already full, right? You already had a full portfolio of public company equity, and now you've just been injected with another large chunk of public company equity. That cup is now overflowing. You have to figure out what you need to sell to make room for that new allocation. And this happens, often, anytime there's an IPO, but most of the time it's just, basis points of overflow. So really not a meaningful difference. When it is trillions of dollars of overflow in portfolio terms, that could be, mid to high single digit percentages of your portfolio. So there's going to be a need for those institutions and all the way down to individual advisors. There's going to be a need for them to figure out, okay, well, now I am overweight private equity. I need to rebalance my portfolio. What do I sell to transition either back into fixed income or back into private equity to make sure that I have the right asset allocation. So that's going to be the problem that a lot of institutional and retail investors are faced with over the next couple of months, couple of years, as these large liquidity events continue to occur. So just something to think about. Most of these liquidity events are happening in the U.S. equity markets, which means that as a percentage of the portfolio, U.S. equity markets are going to continue to increase. The benchmarks are going to continue to increase. That's going to likely result in some, I'll call them not quite forced, but almost forced transactions to rebalance those portfolios. It means money movement from outside of the U.S. back into the U.S. to rebalance, right? It might mean, selling some of your international securities to, accommodate that larger U.S. equity presence in your public market portfolio. So again, those dynamics are things that we can look at and we can kind of, see, okay, well, this is kind of where the puck is heading. These are some things that, are natural transaction outflows of those large capital movement events. And then, kind of last couple things today. So we'll talk about, we're going to stay on the technology topic. There was an article and created a lot of consternation, especially in the cybersecurity space. The announcement of the model out of Anthropic called Mythos, which is supposedly a more advanced model than Anthropic's most current model, which is Opus 4.6 or 4.7, right? So this Mythos model is supposed to be really, really good at finding ways to expose loopholes, access points into secure software environments, secure technology environments. I've spoken to a couple individuals with a background in cybersecurity, try to get my head around, what is the extent of this problem? Is it something that I should be concerned about? Is it something that our clients should be concerned about? And is this Mythos model really something that is a game changer? And the way that I've really tried to understand it, and the way the conclusion that I'm coming to, and obviously I'm an investor, right? So I'm not a cybersecurity expert, although I play one on TV sometimes, is that this Mythos model, what it is really good at, again, finding different ways, call those loopholes, call those just ways to get access to software systems, little known or unknown bugs that might be sitting around for years and even decades at a time, and then piecing those bugs together to access a secure environment, right? So that's the big concern. And what this model is able to do is it's able to do that with very little guidance, okay? Now, if we were to turn the clock back 6 months when we didn't have this model, however, you had a cybersecurity expert, a quote unquote hacker, and they had the most advanced models at that time, they still had some pretty advanced tools to try to break into software systems. And then on the other side, the good guys, right, they have some pretty advanced tools to try to find the bugs in those software systems and close them. So it's, in this case, it's really just, in my view, a situation of, the good guys have a much more advanced tool. They need less expertise to expose holes. The bad guys maybe have an access to this tool as well, and they need less expertise to expose those holes. But I think in the hands of a highly trained, cybersecurity expert, I think those individuals are probably still equally effective. I don't think that this Mythos model really upskills them to any significant degree, but I think what it does do is it does lower the bar for a potential bad actor to have, advanced tools to access these systems. Now, obviously, Anthropic has controlled the access. They have not released Mythos to anybody other than maybe some, government agencies to do some testing, and then maybe some large software companies to help show and close those loopholes. So I would say that this tool is still in the hands of the good guys. But it does bring up a concern that, if Anthropic can build this tool today, who can build it in 6 months or in 12 months? And how are those how are those entities going to use that tool? So it is an interesting thing to watch. But today, I don't think it is a extreme game changer. It doesn't make me think that our systems are extremely that much less secure, but it does raise the ante for the cybersecurity industry to continue to innovate and improve on what they're doing, and to also close those loopholes. And I just wanted to give you guys a little bit of note. So at Avidian, we've been investing a lot of time, a lot of mind space, a lot of energy into the AI world. We invest in a couple ways. Number one is we find opportunities that are exciting and interesting to us that we can place our clients' capital into. So that is the number one focus for us. However, to better understand those opportunities and also to make our investment process more advanced, more scalable, more reliable, and more robust, more in depth, we are utilizing AI tools internally, right? So we are actually, as an investment team, building an AI native framework for doing things like individual stock and individual private company research and fund research. Those tools have kind of helped us, upskill some of the things that we're trying to do, and also added scale to our business. However, I think it's, we can probably share some of the things that we're doing that I think are maybe starting to form up into best practices. So as a team, we're sharing repositories of skills. That's, how do we build knowledge? We try not to build knowledge in silos. We try to build knowledge in a way that is distributed to, the team, right? So everybody can contribute to that knowledge and also benefit from it. We use curated agent marketplaces where we do try to use, some customized agents, a customized list of agents. And also we start to find which agents work best with, some level of guidance on the specific problems that we are interested in. So I think that's a good thing to know, like what agents are well suited to your problem. What agents are, maybe not so good. We've also created some standardized guardrails in terms of, the security around our AI environment is highly secure. It's as secure as anything else that we do. And we're also very careful about the data that we place into that environment. We make sure that it's not data that can be, there's no client identifiable data, right? It's kind of an agnostic data set. It's more used for research. And so we do try to create guardrails there. We use a concept called sandboxing, which basically means we build things to test out and to run in an area where they're kind of isolated from the rest of the things that we do. So nothing, there's no rogue agents that we're worried about. So I thought it was kind of helpful to just share that with some of our listeners. This is something that, we are still learning. We're getting better at it every day. We're very excited about the impact that it's going to have on our ability to bring great investment opportunities to our clients, but it also to do so in a way that, is even better than what we've been able to do over the past handful of years. So with that, I'm going to wrap up. Again, a lot of topics today. Any of these things sparked your interest and you want to take the discussion deeper, just come check us out at avidianwealth.com.